Greetings, Keith Prather here again with Armada Corporate Intelligence, strategic partners with NCM Associates. And this is the April automotive update. I'm going to share my screen real fast. Got it. Okay, so one quick point on the macroeconomic outlook. We are seeing now at least the threat of recession being removed completely from the forecast. So as you can see here, Q1, we've got it listed here at about 2.1%. It actually came in a little bit weaker at about 1.6%, which a little bit below expectations. There's three more revisions that are supposed to be coming over the next few months, but for now, it feels like we have a reduction in government spending. That's what it looks like. It looks like consumer spending was still pretty stable, which is what I think most of us from the automotive industry is going to be most focused on. And so at least it looks like from that perspective, consumer spending is still tracking the way we thought it would. Again, for the full year, we're still looking at somewhere around 2% growth. For 2025, then kind of settling back down in that just slightly sub 2% growth rate. One thing I wanted to point out, though, also is that especially for automotive, and this is important even for the higher end brands, also for mid-level brands, but there is a big correlation between what's happening in the stock market and consumers' ability to spend money. So we know that in 2023, there was over $900 billion in new incremental wealth created on Wall Street. About $288 billion in additional consumer spending resulted from that. And a lot of it is just consumers being really confident that, as they see their total assets and their total investments start to surge, that they've got the wherewithal to go out and spend money. And so that's what a lot of them did. So that's a good backdrop. And at least so far, year to date, we're seeing about a 9% growth in the S&P 500 year over year. It's up about 16%. So some of those trends continued. And as long as we have a good stock market, good stock performance, I think that's going to relate into better spending, at least on the automotive level, especially for mid-income household levels and higher. So then turning to, if I can get it to work there, the NCM Automotive Demand Index, the ADI. So this is just the demand side of the equation, at least for now. It looks like consumer demand is still strong. I would call it strong. We look at this in relation to where it has been in the past. So demand is a little bit stronger than it was just prior to the pandemic. But maybe a little bit weaker than it was kind of back in the cash for clunker days and kind of in that period between 2011 and 2014. But generally doing pretty well. And we also like the near-term trend. So of the last 4 months, it's actually been increasing. And so we like that trend. It means the demand side of the equation, there's still good demand as long as consumers still have the wherewithal to actually spend, and that'll be the key. And what we're watching mostly is this correlation between real disposable personal income. So this is inflation adjusted income that most households have available at the end of the month to go spend on other things, especially big ticket items. And this is also going to kind of give us an idea of how willing a lot of consumers are going to be to take on new debt. And so right now we're getting a growth rate of about 1.4%. Just for comparison, over the last year in 2023, it grew at almost 4%. So we do see deceleration in inflation adjusted disposable personal income, and that could have a little bit of a dampening effect on auto sales overall. Again, especially for those households that are earning less than $75,000 a year, a combination of tighter inflation impacting those households, a little tougher job market, more part-time jobs available than full-time jobs, which affects their ability to spend and to take on debt and get loans, et cetera. So we've got a little bit of pressure there that we're still watching. For the industry itself, though, we're watching auto sales, and auto sales have been pretty strong. So we're still, selling roughly a little over 15 million units. We'd like to see it a little bit closer to that 17 to 18 million unit rate that we had just prior to the pandemic. But at least we're seeing the trend is generally increasing, which is good. And I think a lot of that has to do with what's happening on the inventory side. We're starting to see the inventory to sales ratios get back up into a range that before long we'll be able to call normal. We'd love to see the inventory to sales ratio back up to somewhere around 2.5 months of inventory on hand. I know for EVs and some types of vehicles, I know our days on hand has exceeded where we would like to see those goals. But the industry as a whole, right now, we're still running right at 1.3 months of inventory on hand. And again, this is relative to sales. So as an industry, as a macro industry indicator, we're still seeing it this way. Speaking of one of the Group 20 events, I just asked for a show of hands across a lot of different brands in the room. Obviously, who was sitting heavy on inventory and who was light on inventory. And about 50% of the room raised their hands that they were light on inventory still, didn't have enough of the right models or the right inventory to be able to meet sales demand. So this feels about right, at least just from an anecdotal perspective, and then what we're seeing on the data side. So last piece that I have for you in this wave is just a forecast that Armada puts together looking at auto production. And we're kind of seeing more of a flat trend. And that flat trend kind of continues over the next 18 months. And we think part of that is just getting back in cycle with inventories. Now, when you look at it on a longer term, you can see that at least what we're projecting through the next 2 to 3 quarters is a strong growth trend in overall production, hitting almost a new all-time peak high for production overall before kind of softening in the back half of 2024 and then early in 2025. So, excuse me, this particular model has actually performed very well. We're hitting about a 99% accuracy rate 6 months out, 92% 3 months out. So there's some volatility in it, but at the same time, what we look for is either downside or upside bias, and right now the models are giving us upside bias. So again, overall, looks like it's going to be a pretty good environment for automotive sales. So that's what I had for you this month. Again, take a look at the report that we put out every single month, and if you have any questions, feel free to reach out. Otherwise, we look forward to seeing you next time and next month. All right, take care. Bye bye.